we have an exciting intraday update for you guys. We just heard from Fed Waller. We heard from McCarthy. I want to get into what they had to say. Fed Waller, again, is in line with what other Fed officials have said in being, don't expect a pause at the Fed meeting. This could mean more downside for big tech. This could mean margin calls in a collateral crisis could be closer than a lot of people want to think about. Now, on top of that, this is going to be the best part of the video. We're going to try to quantify, using the numbers here, what the short interest in AMC stock really is. Because we've seen a lot of synthetic shorting. And a brief rundown of what I think synthetic shorting is. Maybe it's not the right terminology or whatnot, but it's essentially when hedge funds, they go out and they buy deep in the money put options, which acts the same way as shorting a stock, right? But instead of those hedge funds going out and actually shorting these shares, the market makers go out and short the shares. So you're still at the same short level. You still can see the same kind of shorts covering action. It's just done by a separate entity. It's done by the market maker. So what you've seen recently with AMC is not a lot of shorting from hedge funds, but a lot of shorting from market makers due to the option activity. And there is a ton of it, guys. So we're going to get into everything you guys need to know on AMC stock here today, as well as quantify the short interest and where the likely percentage of the free float that is sold short is currently at. So let's get into it. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. So first things first, let's start with the boring stuff. Let's start with the Fed. Let's start with McCarthy, and then we'll get into AMC. So Fed Waller just came out and he stresses flexibility for June rate decision. He says that the Fed will need to, quote, maintain flexibility on whether it should hike, pause, or skip June with an inclination to increase rates in July. He did express doubt that the Fed has gone as far as it needs in its fight against inflation. Quote, I do not expect the data coming in over the next couple of weeks will make it clear that we have reached the terminal rate, Waller said in prepared remarks for a speech in Santa Barbara, California. Quote, and I do not support stopping rate hikes unless we get clear evidence that inflation is moving down towards our 2% objective. But whether we should hike or skip at the June meeting will depend on how the data comes in over the next 3 weeks, he added. Now, that's the big update we got from the Fed today, in line with what we have been hearing from other Fed speakers. Mix that with this unscheduled meeting that Jerome Powell had with Democrats. It's very weird, okay? And it leads me to believe something else is coming here on the near-term horizon. Maybe the market's expectations will start to get upset, and the markets will have to go from pricing in a pause to now all of a sudden pricing in another rate hike. And that is not what the markets have expected. And if you look at the probability of another rate hike in June, it's sitting at 71.8%. Actually, it did just go down after Fed Waller's comments to 67% chance of getting a rate hike, 33% chance, 67% chance of a pause, and 33% chance of a rate hike. So you're not expecting a rate hike by and large in June. And the Fed, maybe they have some inflation data before we do. You know, maybe there's a reason they're saying all of this that we're unaware about right now. But it is flipped. The Fed's verbiage has flipped from, yeah, I think we should hold and pause, to, well, maybe we should raise rates again. Some people like Bullard saying the Fed should raise rates 2 more times in June and then once more in July. So that's a big update here on the day today. Now, coming out here in just a couple of minutes, about half an hour, you're going to get the FOMC minutes. Now, the minutes, investors are looking for kind of clarity on why the Fed, raised rates at the last meeting and what they're especially going to do in the next June meeting. If there's a lot of people that were pretty hawkish on inflation, if there's a lot of people that kind of expected, to raise rates and potentially even raise rates in June, we're going to get some kind of signs of that. We're going to get something that points in that direction. And like I said, based off the current probabilities of a 67% pause in June, that could definitely shake up the markets right now. It's just not priced in for another rate hike in June. So that's what we got throughout the rest of the day today. And like I said, you have NVIDIA earnings and after hours. Think AI, think big tech. They have carried the markets. The markets are actually flat in 2023. After the last 2 down days now, the equal weighted S&P 500 is down over 1% for 2023. The average stock has not done well. If you have been in the top 5 or 10 largest companies in the US stock market, you've done fine. You've done okay. And that is obviously because of AI. Everyone loves AI all of a sudden. This has been around since 1951. But you've added hundreds of billions of dollars in market cap to these companies. If NVIDIA earnings are not good or signal maybe AI is going to take longer to catch on, that's not going to be good for your big tech. And that's where you get into kind of the collateral crisis that I think is coming, as well as those upcoming margin calls. Now, that is your update here on the day on the broad markets. Markets overall down. NASDAQ down about 1%, S&P down 0.80%, Russell 2000 down 1.35%, and the Dow Jones down 0.67%. So you're not getting really any good news right now, and the markets are finally starting to react to negative news. For a while there, you were getting negative news, and the markets just would not respond negatively to it. That seems to be coming to an end. Now, let's go ahead and run through the Ortex data with AMC and then jump straight into trying to quantify and trying to put a number on where the short interest likely is for AMC. And, you know, before we dive into the short interest data and all that, I do want to point out again, every single day you're seeing the $10 puts and the $13 puts being attacked by shorts, by hedge funds. Today, you're seeing a July 21st $10 put for $1.5 million. A couple orders in here, anywhere from $100,000 to $500,000. And then another one, a July 21st $10 put for another $1.5 million. It's clear that they're doing this. They don't want the short interest to look, you know, or to reflect the actual short interest. They want it to seem, you know, 25% or stay on the lower side, when in all reality, it could be 30, 40, 50% with the option activity that we are seeing. Now, the live short interest of free float sitting at 25.23%, 130.27 million shares currently sold short. Cost of bar average 75.5%, cost of bar max 93%, cost of bar minimum at about 31%. Interactive brokers seeing a spike in shares available to be lent out today, sitting at about 900,000 with a cost to borrow rate of 47.36%. And it's obvious here too, someone is trying to lend out stock to push these cost to borrow fees down, in which we kind of forecasted, because after all, those cost to borrow fees are insane. Even where they are now, 47%. You might think of that like it's nothing because the cost to borrow fees were just 1,000%, but 47% is still a lot. That's still ridiculous. You need to see a huge drop, even with a 47% cost to borrow fee, to make that actually make sense. Now, let's dive into this with the Stonko tracker data, and then let's get into the option chain. So, a lot of the option activity that we're seeing, sure, you do have a decent amount from now, from May 26th, from this Friday to June 9th. It's a decent amount of option activity, nothing crazy, but June 16th and July 21st, that's what I really want to focus on here. If you look at June 16th, you got 439,000 calls out the money, 2,400 calls in the money. Very small ratio. If you do see an uptick in AMC, obviously you'll probably get a lot of calls going into the money. That will be very bullish. If you look at the put side of things, 338,000 puts in the money, 489,000 puts that are out of the money. Stupid high numbers here, okay? If you look at July 21st, again, 2,000 calls in the money, 360,000 calls out the money. In the money puts at 374,000, out the money puts at 501,000. Based off of these numbers alone, this drop looks to be getting pretty extended at this point. These ratios are ridiculous, right? Now, let's look at the actual option chain here. So, what we got right now, and we're going to skip to June 16th, is at the $5 put, which is in the money now, 117,000 contracts. At the $6 put, 111,000 contracts. At the $10 put, 64,000 contracts. Even at the $17 put, you're looking at 12,000 contracts. That really just doesn't make a whole lot of sense unless you are really trying to, suppress the stock. Like, the retail is not buying $17 puts, okay? That's just really not happening at all. And if you are doing that, well, let me know down below in the comment section, because that just doesn't even sound right. Okay, so we're going to go ahead and add up the options that we're seeing for this expiration that are especially deep in the money. Almost done. Perfect. 86,000 puts that are in the money right now, that are deep in the money. That's not considering at the $4 strike, you got 140,000 puts for open interest, 175,000 puts in open interest at the $3 strike, 123,000 puts at the $2 strike, and the $1 strike has about 48,000. So we're not even looking at that. We're looking at puts that are in the money, that are actively being hedged, and that account for shorts on AMC. Because market makers, if you guys are unaware, when hedge funds go out and they buy these deep in the money puts, if a hedge fund were to win on that put, someone loses. Now, market makers, they take the back end of those options. So market makers would lose. So what do? They have to go out and hedge. They have to go out and sell the stock short. That's the same way that a gamma squeeze works to drive a stock up. A reverse gamma squeeze pushes the stock down, and that's what you are seeing right now. Now, if we go ahead and take a look at the July 21st option expiration, this is a big one for that $10 put. $10 put alone has 271,000 contracts that are out of the money. Absolutely insane numbers that we are seeing. Just ridiculous numbers that we're seeing right now. So let's go ahead and add up some of the options that we are seeing right here. 271,000 at the $10 put, another 17,000 at the, $6 put, another 64,000 at the $5 put, and we'll just leave that like that for that expiration. So 352,000 puts that are deep in the money that have been hedged for already by the market makers, meaning they're active shorts that are on AMC. Now let's go ahead and go back and re-add the June 16th options. And again, we're going to use the $5 put, the $6 put, as well as the $10 put, because those are all in the money. And again, we're not going to account for the puts that are not in the money, because those are likely not already hedged for. So to kind of get an accurate representation of, how many shares might be sold short by market makers in AMC alone, you got to just use these numbers right here, these contracts that are already in the money. Now, what you'll want to do here, you get 644,000 contracts. Now, we only looked at the big option expiration, so you could probably add another 20, 30,000 options to this. That would, be appropriate, but we're just going to leave those aside just for good measure here. You're going to go ahead and times that by 100, because each option represents 100 shares. And you're looking at 64,400,000 shares that are likely sold short right now by market makers. Now that we have that 64, almost 64.5 million number, Let's go ahead and look at what is currently sold short in AMC stock. What we can actually see. Well, you have 130 million shares that are currently sold short in AMC. So we add this to the total. 194 million shares that are sold short in AMC. Likely by, again, the market makers being a good percentage of that. Now you want to go ahead and divide this by the float of AMC, which is about 517 million shares that are sold short. That would put your short interest at, if you want to round up, 38%. That's probably more so where the short interest actually is, if you were to account for the shares that are sold short by the market makers. It's technically 37.6% short. So, I mean, a lot of people don't realize this, right? A lot of us, a lot of retail investors are not going to realize that the stock is actually a lot more shorted than what these numbers really look like. And then that's just because they're not shorting the shares anymore. They're shorting, or they're buying the puts, which is allowing the market makers to short the stock, which does not get recorded in the short interest data. So that is going to do it here in this video. Ladies and gentlemen, thank you guys for watching. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.